I'm catching up with John McBain, the Joint CEO and founder of Centuria Capital. You are a founder, weren't you?
Yeah, thank you, Eddie. Yes, that's got a long time ago.
Yeah, it is a long time ago, but you're still looking pretty young despite it all.
Oh, thank you.
I might be biased.
I'm feeling it.
All right, I want you to explain, because some people have invested in Centuria buildings along the way, and you had a really good run. I can't remember the last rotten building you were involved in. Anyway, you would buy that. Then there's Centuria Capital, which is listed on the stock market. So you just explain so people understand the difference between Centuria Capital and those buildings that you invest with others.
Yeah, sure, that's a fair question. So we have a large number of unlisted trusts that operate. We manage them. As well as that, we have listed trusts, which there's an office listed trust, CMA, and an industrial listed trust, CIP. So people have a choice to invest in either generally a single asset.
So the unlisted one tends to be a single asset.
Tends to be, yeah. And then the listed ones are really, they each have a portfolio of assets, and they're getting quite large. They're both either 1.5 billion, something like that, getting relatively large. We've recently, 18 months ago, introduced another unlisted product, which is designed to be more liquid. So generally those single asset trusts are fixed terms, and they might be 5, 6 or 7 years.
Yeah, so people put their money in, they're a part owner effectively, 5 or 6 years, they get the rent along the way, and if it's selling at the end of a capital gain, you split it.
But what we noticed was happening was we're quite fussy what we buy, obviously, and people weren't like the unlisted concept. They like some people would rather invest in a REIT and a listed trust. Some people might prefer, a lot of people prefer unlisted. That's fine.
They can see the building.
They can see the building. They know which one it is. We've also introduced another product called our Centuria Diversified Trust. That's very popular. So in between times where we might not have bought an unlisted building, there might only be 3 or 4 buildings a year. They can invest in this diversified pool of properties, and that's got some liquidity, so they can enter into that.
A bit easier to get out than once somebody locks in for 5 years.
Yeah, it's not totally liquid. If there was a run of every single unit in the stock, there's rules, but it's certainly, we've never had that occur.
And so all the money made in either the listed or unlisted eventually ends up in Centuria Capital, and that's the big listed stock.
Yeah, so that's the listed stock that I've always grumbled to is undervalued.
That's right. Until recent times.
Yes, till recent times, and
so people who listen to us might have done okay.
Well, if they hadn't sold their stock, I'd say they'd be extremely happy. That stock now has a market capitalisation of about 1.1 billion. Itself, it's CNI or Centuria Capital, so that's where all the management fees end up. We've just put out earnings per share guidance of 12.5 cents. It'll have a distribution of 9.7 cents, still a very good distribution. And its performance has been really good. Things, and like for example, the first 6 months of this financial year in our vehicles, in those managed vehicles we talked about earlier, they've bought 1.2 billion of assets. So that's lifted our funds under management in the whole group to 7 billion. And they're all good assets and we're very proud of them. But as the assets under control get greater, so the management fees that flow to the Centuria Capital business increase.
Yeah, because there's a small percentage on those, and they eventually end up being dollars in the headstock.
Yeah, and the principle with funds managers, we're a listed funds manager, so we're a pure funds manager. The principle is, of course, that if your revenues from management fees grow faster than your cost base, that should be very, very good for your security holders.
Yeah, okay. And you've recently moved into your homeland. Yeah, I know you're an escapee from New Zealand.
Happy to be here.
But you've gone back home and bought something. Explain what it is and what impact that might have on Centuria Capital.
Yeah, that's very recent. So last week we announced a proposed takeover of a company called Augusta Capital in New Zealand. Actually, eerily similar to our business probably 7 or 8 years ago.
Yeah.
It has a lot of unlisted trusts, a lot of very, very loyal investors. It also controls a listed trust as well as its unlisted trust, and all of its managed vehicles total up to just over 2 billion Kiwi, so about 1.9 billion Australian, and it's the same theory. We've got, provided that bid proceeds and is successful, and we believe it will be, that will take our funds under management in our whole entire group from about 7.1, 7.2 to roughly 9.1, 9.2 billion Australian, real dollars.
Yeah. So you said that, not me.
Yeah. So that's, and once again, very good business, very well run, very experienced, very good loyal investors. We think the New Zealand property market has a lot of similarities to the Australian one. I admit that some of the assets aren't quite as large, but we still think it's got quite good fundamentals. Certainly the land title system, the way they transact, the real estate agency system, it's very similar to ours. So we think it'll be good. We've got 36% of the shareholders have already agreed to support this bid. We've got, provided our bid is as we've set out in our documentation, their board will support it. So we're hopeful it's going to be a relatively smooth transaction.
All right, so one thing a lot of people are wondering is that your sector, and you're basically, correct me if I'm wrong, you're in commercial buildings, you're in industrial buildings, and what else is a third area?
We have a health area.
Yeah,
so correct.
But the commercial industrial,
healthcare, real estate.
Yeah. So commercial industrial is your real bread and butter. Now, before I got to know you, there was a thing called the GFC, and a lot of REITs, and you're in the REIT space, really copped it because they carry too much debt and all that sort of stuff. And it's been a great run ever since. And some people will be worrying, well, eventually, can this great run continue? Is the period of unbelievably low interest rates a part of the reason why you guys continue to do it? Apart from your own independent brilliance and picking good buildings and whatever, and the fact that the economy keeps growing, is it low interest rates a big plus for you guys?
Oh, undoubtedly it's a plus. However, we would argue we could make good profits from transacting in commercial industrial real estate, whatever the interest rate was. And we have done in the past. The effect of the interest rates, funnily enough, it supports asset values, not just real estate asset values. You'll be aware a lot of our infrastructure, a lot of asset values around the globe is being supported by low interest rates, which incidentally, our not that we're economists, it's very difficult for us to see what's going to put real upward pressure on those interest rates. I'm sure it will happen at some time, but in the horizon that's foreseeable for a corporate, it's hard to see it. So I think the impact has been on supporting asset values, you're correct. Where the huge impact has been for funds managers like us, people have very low returns in their traditional cash safe havens. And your listeners and viewers will know that around 1%, not attractive, particularly if you're retired. It's trying to find something that has a higher return, and I don't mean ridiculously high, but a higher return where you're not getting over gearing or you're not taking on too much risk or risks you don't understand. And that's one thing that we try and do when people are approaching us to invest with us. We're very keen to tell them what the positive things are, but and we've always been very keen to say, well, look, there are risks, and here they are. We don't gear our listed or unlisted products too highly. Certainly not like the old days. Neither do our competitors. We've all, I think with a unlisted trust, what might have been 60 or 65% gearing will now be 40 or 45%.
Okay. I know there's not a space you play in, but you might have in the past and I've forgotten. But retail property, all the challenges with retail. Is there any value in retail going forward?
the R word. Yeah, look, I think, firstly, we appear to have we might have the appearance of some brilliance by not ever being in retail, but frankly, we just never liked it. And when I say never, not for 25 years. Certainly, it's in difficulty at the moment, and I feel sorry for some of those guys. And I think there's a little bit more to shake out. We've got several of our friends own a lot of retail real estate, and they do very well at it. I think regional retail seems to be doing better than some others. But I talked to some guys on the weekend, professionals. Good funds managers will find a way through their retail portfolios. They'll adaptively reuse parts of it. I just think it's unfortunate that rents have got quite warm, and online has hurt a little bit, but we're not smug about it. We, as I said, it wasn't predestined. We just never liked it.
Yeah.
You know, we're very happy with our office blocks, our industry, our industrial investments. Very happy with our healthcare investment we made, Centuria Heathley. And the only thing that the New Zealand business does in New Zealand, it's got involved with some tourism assets, hotels on long leases, which we haven't done in Australia, but I think it's quite exciting.
Yeah, provided the coronavirus doesn't go on for too long.
Or reach New Zealand in any great numbers.
Yeah,
you know.
Right. I guess one last question to you, mate, is the outlook for investing in the kind of real estate assets you chase. What's the? You can't be necessarily 100% right, but what are you operating off?
Oh, look, and our strategy going forward is, we think our strategy period's really 24 months, then looking out for the third or fourth years. But over the next 24 months, we still find it very hard to believe, unless there's some black swan event, and I don't think the coronavirus is going to be that, incidentally, from what I've read about it. It's not multiplying logarithmically, and I think the world is responding better to it. It has to be some black swan event. We cannot see sovereigns suddenly writing off all the bad credit they've adopted, and we can't see interest rates going ridiculous. Now, while that happens, asset values will be stable. We're even predicting valuation increases on quite a few of the office and industrial portfolios, which we mightn't necessarily want, but I think it's coming. So, best for people to invest on fundamentals. Look, find a good manager, make sure they're not over-gearing their product, and invest in something. If it's going to be an unlisted syndicate, invest in something you feel comfortable with, and maybe do 2 or 3 investments rather than one. Yeah. Not that we're allowed to give advice, and my people in my office will be
just brilliant financial education.
Just the sort of advice you give your clients. We'll have so much in one sector, so much in another, so much unlisted, so much listed. I think that sounds wishy-washy, but I think that's the position we're in. I think the next 18 months to 24 months are going to be very positive.
I think it's good advice, particularly at this end of the cycle. You can take more risks at the beginning, but at the end, diversification is the best way. Even though Warren Buffett said diversification is for wimps, I'm a wimp when it comes to investing. John McBain, thanks for joining us.
Thanks, Peter.
John McBain, Joint CEO of Centuria Capital.